A vote has just gone off in the Senate chamber. I was one of the first to vote, and so I'm here now. So I can go through some of the rudimentaries of the hearing and welcome our witnesses. Barry Johnson, the acting chief of research and analytics at the Internal Revenue Service. Douglas O'Donnell, the deputy commissioner for services and enforcement at the Internal Revenue Service. J. Russell George, the Treasury Inspector General for Tax Administration. Nina Olson, the Executive Director of the Center for Taxpayer Rights. And Charles O. Rosati, former Commissioner of Internal Revenue, currently a Senior Advisor at the Carlyle Group. I'm delighted that you are all here. And would like to, I guess I'll begin with my opening statement, and then that'll give the other members a chance to come here. This is a, I think, important and timely hearing on the tax gap and the related role of offshore tax evasion. My Republican colleagues and I may disagree on what makes a fair tax code, but we very much agree that everyone should pay what they owe. That principle is what today's hearing is about. The IRS conservatively estimates the tax gap, the difference between taxes that are owed and taxes that are collected, to be $441 billion per year. Commissioner Rettig recently testified that the tax gap may have grown as high as $1 trillion in recent years, trillion with a T. One reason for the gulf between the official estimate and Commissioner Rettig's is the bad job the official estimate does incorporating the so-called international tax gap, what is hidden by wealthy individuals and large corporations overseas. Tracking this offshored money is difficult, but we know there's lots of it. Research suggests the Treasury may lose anywhere from $40 to $123 billion every year from offshore tax evasion. Of course, typical American taxpayers don't have the option to hide money abroad. So the wealthy who cheat on their taxes through offshoring also worsen income and wealth inequality. One study estimates the highest earning 1% of taxpayers hide 20% of their income and account for 36% of unpaid taxes. 1% of the taxpayers, 36% of the unpaid taxes. Most Americans pay what they owe, meaning that they cover for the tax cheats through higher taxes, fewer public services, or a larger federal debt. For large multinational corporations that stretch loopholes beyond recognition to book income to offshore tax havens, the line between legal avoidance and evasion may be paper thin and may turn on whether an outgunned IRS can defend against the armies of lawyers hell-bent on burying the IRS in litigation. An outsider looking at these numbers may ask how the most wealthy, powerful country in the world could let this happen. The answer is, we made it happen. Over a decade, Republicans cut the IRS budget by 20%, with enforcement hit especially hard. There are 30% fewer enforcement staffers than a decade ago, and the number of highly trained revenue agents who tackle complex audits of the wealthy and large corporations is down nearly 40%. The result? Millionaire and billionaire audits dropped over 72%. And audits of the largest corporations, those with $20 billion in assets, declined by half. As former Commissioner Koskinen once said, cutting the IRS budget gives a tax cut to tax cheats. As the IRS budget fell, audit rates for the rich and poor in America converged. A worker receiving the Earned Income Tax Credit is nearly as likely to be audited as a seven-figure earner. What do? Well, we should start with the multi-pronged approach of the Biden administration. First, ensure that the IRS has the resources to collect what taxpayers owe. It needs a larger staff with the knowledge and experience to untangle the networks of shell companies the ultra-rich and large corporations can use to hide their income, often in offshore tax havens. I'd like to explore mandatory funding for the IRS so the agency has sustained and predictable support. 2, require more reporting of the type of income the super-rich tend to hide. Regular taxpayers can't hide their wages from the IRS. They're reported by the employer. The super-rich shouldn't be able to hide them either. 3, support a technological reboot at the IRS. The agency still relies on some systems from the 1960s. Modern tools and technology could help root out offshore and other types of tax evasion. The investment will pay off. Treasury estimates that $80 billion spent to revitalize the IRS will yield $700 billion in revenues, funding that we could invest in working families. I'll note that budget scoring rules block Congress from using that high return investment as a pay-for. That needs to change. Ramped up enforcement is essential, but it's no substitute for addressing the fundamental injustice in the tax code, particularly the tax breaks for the ultra-rich and large corporations. For example, my No Tax Breaks for Outsourcing Act would end the incentive for multinational corporations to shift profits offshore. I'm pleased to be joined by such a distinguished panel of witnesses to discuss the size and scope of the tax gap, the role of offshore tax evasion in that gap, and what we should best do to combat it. And I don't know, Senator Grassley, if you're here in place of Senator Thune as acting ranker and wish to make a statement, or if we should go ahead and let Senator Thune make his statement when he arrives.
Please go ahead.
Okay, we'll do that. The first witness we will call is Barry Johnson. Mr. Johnson, thank you very much for your participation in this hearing. Please proceed with your testimony. If we could hold on a second while the technical people connect things. In a hearing about technical difficulties and impediments, the IRS doing its job, we're having technical difficulties with getting the IRS witness to sign in. So why don't I go to a live witness, and we'll let the technical stuff catch up with us. And let me start with Mr. George, please.
Press the mic, or is it's on?
You're good. You're on.
Okay, thank you. Chairman Whitehouse, Senator Grassley, and members of the subcommittee, once they arrive, thank you for the opportunity to provide information on the IRS's efforts to address the tax gap. The tax gap is a long-standing issue that has been a substantial challenge for the IRS. Finding effective solutions to this challenge would yield substantial additional tax revenue. As you noted, Mr. Chairman, the tax gap estimates currently in use are outdated and the tax gap is likely much higher at this point in time. IRS studies have shown that audits have the largest impact on tax compliance. The IRS lost 15,000 enforcement employees between 2010 and 2018, which led to a significant reduction in the number of audits, also referred to as examinations. Over that period, the number of examinations dropped by about 40%, even as the number of returns filed grew by 5%. Since 2010, the IRS has conducted fewer examinations. Between 2010 and 2018, the share of individual income tax returns examined fell by 46%, and the share of corporate income tax returns examined fell by 37%. The percentage decline in the examination rate was larger for higher income returns. For returns with more than $1 million in total income, the examination rate dropped from 8% in 2010 to 3% in 2018, a 63% decline. In March 2021, TIGTA reported that the IRS could more effectively prioritize high-income taxpayers who owe delinquent taxes but do not pay. In addition, we have also raised concerns that in 2015, the Small Business Self-Employed Division of the IRS terminated its high-income, high-wealth strategy, which was designed to address high-income taxpayers who had not reported all of their earned income. Tax gap studies have found that self-employed individuals underreported their net income by 64%, which is up from the 2001 estimate of 57%. With the growth of online platform companies, it is likely that income and self-employment tax underreporting will continue to be a growing problem. TIGTA issued an audit report on the gig economy's impact on tax compliance and the lack of an IRS strategy to address this challenge. We reported that the IRS is not working cases with billions of dollars in potential tax discrepancies involving taxpayers who earn income in the gig economy. Many cases were not selected to be worked by the IRS due to resource constraints and the large volume of discrepancies that were identified. The use of virtual currency, also called cryptocurrency, is emerging as an alternative asset to U.S. and other currencies. However, we found that it is difficult for the IRS to identify taxpayers with virtual currency transactions because of the lack of third-party information reporting. Non-payment of taxes owed is a smaller proportion of the tax gap, estimated to be $39 billion annually. Reductions in resources have also impacted payment compliance. From fiscal year 2015 to fiscal year 2019, field revenue officers have decreased by approximately 14%, from 2,612 to 2,239. Improving international tax compliance remains a challenge for the IRS. The IRS has not developed a reliable estimate of the international tax gap. Non-IRS estimates of the international tax gaps vary widely. Previous estimates range from $40 billion to $123 billion annually. Congress gave the IRS important tools to help stem international tax evasion with the passage of the Foreign Account Tax Compliance Act. TIGTA reported that after 8 years of spending at least $380 million on IRS systems and efforts to establish international agreements across the globe, the IRS has not taken the compliance actions needed to meaningfully enforce it. In conclusion, the IRS can more effectively reduce the tax gap by developing compliance strategies for the changing domestic and global economies and using its resources and information reporting more effectively. Mr. Chairman, that concludes my statement. Thank you for the opportunity to share my views.
Thank you very much, Mr. George. I appreciate it, and on behalf of myself and also Senator Grassley, who is a longtime friend of the Inspector General community and a great one for whistleblowing and transparency, let me thank you for your service to our country as Inspector General. Mr. Johnson is still experiencing some technical difficulties, so if we could turn now to Doug O'Donnell, the Deputy Commissioner for Services and Enforcement at the Internal Revenue Service, to make his statement. Mr. O'Donnell.
Douglas O'Donnell. Earlier this month, I became the Deputy Commissioner for Services and Enforcement at the IRS. Before stepping into that role, I spent several years as a Commissioner of our Large Business and International Division. I appreciate the opportunity to testify on the tax gap. My colleague Barry Johnson will talk about the technical components of the tax gap and how we measure it. I'll discuss what the IRS is doing to address the tax gap, to increase compliance, and ensure the integrity of our tax system. Addressing the tax gap requires both service and enforcement. We need to help people who want to comply with the tax laws and track down those who willfully refuse to fulfill their obligations or commit tax fraud. The entire IRS workforce is focused on doing the very best we can in both of these areas with the resources that we have. This includes employees who develop clear and understandable forms, instructions, and publications, answer taxpayer questions, process e-file and paper returns, and audit returns and investigate tax fraud. Every one of us at the IRS has an important role to play in providing service to taxpayers and ensuring compliance with the tax laws in a fair and impartial manner. But we struggle to keep pace with change. The size of our economy, the number of taxpayers we serve, the complexity of the tax law, and the global nature of economic interaction account for much of the challenge we face to keep pace. And our ability to deliver our mission is limited by the level of funding that we receive. The IRS uses the tax gap to help decide where to deploy our limited resources, to minimize burden on compliant taxpayers, and to concentrate on reaching taxpayers who avoid complying. Thanks to the help of artificial intelligence, advanced data analytics strategies, and emerging tools, we're able to identify areas of noncompliance in ways that were impossible just a few years ago. With that said, there is room to further modernize these efforts, and the IRS has requested funding to do that. Likewise, the IRS has asked for modernization funding that will allow us to make better use of the data we already collect. Yet, we cannot devote all the resources to just the deepest pockets of noncompliance. It is important that the IRS have a presence in every neighborhood, so to speak. If the IRS were to stop auditing one segment of the population, then noncompliance in that segment would be more at risk to increase. That's because tax enforcement has not only a direct effect on taxpayers we audit, but also an indirect deterrent effect on taxpayers generally. To ensure compliance with the tax laws, we are exercising our best efforts with limited numbers of experienced, specialized examination personnel covering enforcement from several angles. In my previous role, leading the Large Business and International Division, I was very involved in directing how we would address a wide range of noncompliance, both domestically and internationally. A good example is our Global High Wealth Program. This is focused on ensuring tax compliance among the wealthiest taxpayers, those with income or assets in the tens of millions of dollars. Audits under this program look at the complete picture of an individual and the entities that they control. At LB&I, we worked hard to stretch limited resources to address two issues that consume significant examiner time: transfer pricing and the research and experimentation credit. We could improve our risk analysis in both these areas if we had enhanced tools, more data scientists, and additional examiners with subject matter expertise. In the international arena, we have put a great deal of time and effort into administering the Foreign Account Tax Compliance Act, or FATCA. Congress enacted FATCA to improve our offshore compliance efforts by requiring foreign financial institutions to report information to the IRS about accounts held abroad by U.S. taxpayers. While increased tax enforcement is critical to addressing the tax gap, making further progress on the tax gap also requires policy and legislative changes to reduce tax law complexity, to increase information reporting, to improve IRS access to relevant data, and to increase IRS authority in certain areas, such as regulating paid tax return preparers, as the President recently proposed. This concludes my statement. I look forward to hearing from my co-panelists and responding to your questions. Thank you.
Thank you very much, Deputy Commissioner O'Donnell. We have been joined by my distinguished ranking member. We went ahead with the testimony of Inspector General George. We are having technical difficulties that may or may not be resolved with Mr. Johnson. Mr. O'Donnell has just concluded his testimony, so we're 2 down and 3 to go. And if you'd like to make your opening statement now.
That's okay, Mr. Chairman. If you want, once you got underway with testimony, that's fine.
Let me go to Mr. Rosati, if you don't mind. We're still sorting through Mr. Johnson's technical difficulties.
Mr. Chairman, Mr. Ranking Member, thank you for allowing me to testify.
I think you may need to punch your mic button.
Is that better?
Much better.
Okay. Well, thank you for allowing me to testify about the tax gap. We estimate that the taxes that were legally owed and not paid was $574 billion in 2019 and will accumulate to $7.5 trillion over 10 years. This amount was equal to what the lower 90% of individuals, 135 million taxpayers, paid in income taxes. And as we know, Commissioner Rettig recently testified that it might be even higher than that. We estimate that it's practical to recover $1.4 trillion of the tax gap over 10 years, which would still be only 19% of the total. And in our estimate, all of the gain would be from the top 25% of taxpayers and the majority from the top 3%. Tax compliance is heavily driven by whether a taxpayer's income is reported by third parties in a manner that the information can be efficiently used by the IRS. Where income is reported and is easily checked from forms like W-2s and 1099s, compliance is 95 to 99%, and almost all of that tax is paid voluntarily without any IRS intervention. But where income is not reported, compliance is as low as 50%. So our plan for shrinking this tax gap is based on an integrated 3-part program. First, move more of the income from low visibility to high visibility by filling the gaps on income that is not reported by third parties. Second, upgrade IRS technology to make full use of all the information available to the IRS and to increase the efficiency of all IRS compliance activities. And third, rebuild IRS's skilled workforce, but also provide them technology to resolve cases more rapidly and efficiently. It is really critical in our view to use technology to make the entire IRS compliance process more efficient, because simply scaling up what the IRS does today will not produce the desired results. As important as audits are, currently, all of IRS auditing activity only recovers about 2.5% of the tax gap. For example, the IRS today cannot efficiently evaluate information on 40 million K-1 returns, on the 1099-K reports from payers, or on submissions from foreign financial institutions required by FATCA. But modern technology can effectively use this information to identify potential deficiencies more precisely. Technology will also allow the IRS to transform the follow-up process when deficiencies are identified to one that is far more accurate and efficient for taxpayers and the IRS than traditional auditing. And the technology we are suggesting is not futuristic. It is widely used today, including on a limited scale in the IRS, for example, in screening refunds. But most of the gain in our plan would also come from increased voluntary compliance, so it is essential to make compliance as easy as possible. The technology investments we propose would increase the ease and speed of dealing with the IRS and, very importantly, reduce the number of unnecessary audits. We also recommend that this committee follow its bipartisan practice of establishing pertinent taxpayer rights whenever it considers legislating authority for the IRS. And our plan proposes several new or clarified taxpayer rights. Our program would require both authorization and consistent long-term funding from Congress. We recommend a funding increase of about 6% per year above what is required to sustain IRS operations. But spreading this increase over 10 years is what will allow the IRS to make effective use of these funds. Over a decade, the investment will produce a revenue gain of about 20 times its cost and will vastly increase the quality of service the IRS provides to taxpayers. Implementing a program such as this is challenging, but based on my 50 years of managing programs in business and government, I believe it is achievable and very clearly outbalances any risks. As Congress did when it passed the IRS Restructuring and Reform Act some years ago, both compliance and service goals can be clearly established. Progress could be measured year by year and can and should be closely monitored by congressional oversight committees. I note that our proposals are for long-term investment, and in the short term, the IRS certainly must focus on the immediate priorities of the filing season, the Economic Recovery Program, and the new programs such as the child credit. Finally, I believe that fundamental fairness alone is a compelling reason to address this problem, particularly when Congress is contemplating raising taxes on people who already pay what they owe. That concludes my testimony. Thank you, Mr. Chairman.
Thank you very much, Commissioner Rosati. I've got to say, I'm on the Budget Committee where we look at 10-year increments, and your testimony that there's a 10-year increment out there of taxes owed but not paid of $7.5 trillion is pretty stunning. Let me turn now to Ms. Nina Olson, who served for nearly 20 years as the National Taxpayer Advocate, leading an independent organization within the IRS dedicated to assisting taxpayers. She is now the Executive Director of the Center for Taxpayer Rights. Ms. Olson, welcome. Thank you for being here. Please proceed with your statement.
Thank you, Chairman Whitehouse, Ranking Member Thune, and members of the subcommittee. I'm pleased to appear here today to discuss the federal tax gap. To address the tax gap, the IRS needs transformational change, and that change must occur in the context of minimizing undue taxpayer burden and protecting taxpayer rights. That change also will require significant investment in new technology, leadership, employees, training, and procurement skills. It requires a massive redesign of IRS systems so that they update quickly and can process information and talk to one another in real time. All of this is not going to happen overnight, but it must occur. If we do not make these investments in the IRS, we will not only not address the upper reaches of the tax gap, but we will actually risk increasing the tax gap by failing to meet the needs of taxpayers who are in good faith trying to comply with the law. There are a few things we should remember as we try to narrow the tax gap. First, we will never close it. We will only narrow it. Second, the drive to enforce the tax laws cannot come at the expense of taxpayer service. Approximately 2% of the $3.6 trillion the IRS collects each year comes from direct enforcement actions. The remaining 98% comes from the indirect effect of a mix of people's fear of the IRS and their desire to be compliant with the tax laws. When these taxpayers have problems, they call the IRS because dealing with the IRS has consequences that don't accrue to a bad online Amazon or airline transaction. Yet the IRS routinely answers less than 50% of calls, and this year at times answered only 2% of calls to its main 1040 number. The IRS does not have a 360-degree view of taxpayers' accounts because there is no database in which all taxpayer information is stored or linked, so assisters can't provide issue resolution to callers. This lack of a full picture of the taxpayer's tax life has significant consequences, not only for taxpayer assistance, but also for audit selection, collection prioritization, and protection of taxpayer rights. Taxpayer service, which is so important to achieving the level of compliance we have today, must be funded to maintain that level. Third, the tax gap does not equal tax evasion. Framing noncompliance as tax evasion not only undermines compliance among the currently compliant, who begin to feel naive for complying, but it creates an environment in which IRS staff can feel justified in undermining, if not outright ignoring, taxpayer rights and protections. Tax compliance is a continuum of behavior with many causes, including tax law and procedural complexity and economic downturns. We should not treat a taxpayer who has simply made a mistake in the same way as a taxpayer who is actively evading tax. For example, between 2009 and 2018, the IRS offered a series of settlement programs for U.S. taxpayers with unreported foreign bank accounts and income. Although the IRS recovered $11.1 billion from these settlement programs through 2018, just a little over $1 billion a year for 10 years, the data for the 2009 program paint a shocking picture of a regressive penalty structure whereby the taxpayers with the lowest dollar accounts and the least amount of unreported income paid the highest percentage rate of penalty per taxes. Fourth, intelligent use of data can improve tax administration enormously if it is fit for the purpose intended and used in algorithms and other techniques that mimic human reasoning, and if it does not displace human decision-making and discretion. Today, IRS data is mired in the 1980s with some notable exceptions. There is heavy emphasis on data matching and rule-based systems that rarely include feedback loops. Many IRS systems have high false positive and abatement rates. The IRS also does not use data proactively to alleviate burden and prevent harm to taxpayers. For example, the IRS could use its taxpayer income data and allowable expense guidelines to identify taxpayers who may be at risk of economic hardship and protect them from harmful collection actions. Finally, proposals to expand information reporting are very promising, but they must be accompanied by taxpayer protections. Bank account information alone is not prima facie evidence of underreporting. Therefore, if Congress authorizes financial account reporting, it should prohibit the IRS's use of this data in its automated underreporting. Congress should also extend the burden of proof protections of Section 6201D to apply to IRS examination and matching activities. Thank you very much for the invitation to appear today, and I look forward to answering any questions you may have.
Thank you very much, Ms. Olson, and thank you for your long service as our national taxpayer advocate. I appreciate that very much. Let me turn now to my distinguished ranking member, Senator Thune, for any opening comments he should care to make.
Thank you, Chairman Whitehouse. And let me begin by saying I'm looking forward to working with you on the subcommittee. The Subcommittee on Tax and IRS Oversight covers a number of important issues, perhaps none more so than the responsible stewardship of taxpayer dollars. And I am optimistic we will work to find common ground and common solutions. Today we're here to discuss the tax gap, what it is, what its components are, and how to reduce it. The Chairman also has a particular interest in the role of offshore tax evasion, an important issue as well. The tax gap is real. Republicans on this committee support closing it. The tax gap, the difference between taxes owed and paid, has been a stubborn problem for decades. The IRS periodically estimates the tax gap using audits and other data it collects. And as of September 2019, the IRS estimates the average gross tax gap at $441 billion per year for 2011 to 2013. And after late payments and enforcements, I should say, the net tax gap is $381 billion. While those numbers are improvements from preceding years, the tax gap remains a problem. The IRS Commissioner even speculated the tax gap could be as much as $1 trillion per year, a number that far exceeds the official IRS estimate. While that guesstimate might conflate the tax gap with tax evasion, one thing is certain. No one at any income level should believe that they are safe in cheating on their taxes, and we should pursue bipartisan measures to reduce the tax gap and better enforce our tax laws. But any such effort must strike an appropriate balance between taxpayer responsibilities and taxpayer rights. To address the tax gap, some believe that increased IRS resources, tax audits, and intrusion of taxpayers' personal information will automatically yield a golden goose of revenue. For example, President Biden recently proposed increasing IRS funding to $80 billion over the next 10 years, projecting those funds would net $700 billion over the decade. Former IRS Commissioner John Koskinen, who served as commissioner under Presidents Obama and Trump, said he thought that $80 billion was too much. I agree. Based on official estimates about the tax gap and what can reasonably collected, a return of $700 billion is a tall order as well. An analysis from the Wharton Business School projected a lower payoff by about $220 billion. CBO estimated that increasing IRS funds for examinations by $40 billion over 10 years would increase revenues by $103 billion, resulting in a net $63 billion decrease in the deficit. It is not to say that better utilized or enhanced resources couldn't help find real money, but let's be straight about the return on investment, particularly when those figures are portrayed as offsets for new spending proposals. Republicans are open to discussions about IRS resources, but those discussions should include measures to improve customer service, ensure existing resources are allocated optimally, and promote smarter and more effective audits. Just as with President Trump's budget, which also included additional IRS funding and enforcement resources, any increase to the agency should come with commensurate accountability and transparency. Memories remain fresh of past IRS use of taxpayer resources to disproportionately single out conservative organizations for extra scrutiny. Some on the other side of the aisle will say that Republicans hollowed out the agency's coffers, but IRS budgets have been generally stable for the past 15 years. Any budget reductions are compared to the agency's all-time high budget of 2010, which spiked under all Democrat rule. In addition to boosting enforcement, the Biden administration has proposed tackling the tax gap by requiring banks to give the IRS new documentation on income from businesses such as partnerships and sole proprietorships, as well as individuals with business income. Under the proposal, the IRS would soon be recovering troves of new data on taxpayers' bank accounts. As you might imagine, many Americans are understandably concerned with the risk of government overreach. More specifically, they're concerned their local banks could turn into extensions of tax enforcement on behalf of the IRS. While we should look at ways to improve reporting, the IRS should better use the information it already receives, like partnership income reports it has collected for years. Just for everyone to understand, enforcement is only one method to reduce the tax gap. And it's actually 2 degrees of separation between the tax gap estimate and revenue that can be scored from enforcement proposals. CBO budget rules prohibit scoring hope for but entirely uncertain revenue from enforcement. Policymakers need to be reasonable about what is doable on the persistent problem of the tax gap and the limits of score-keeping rules, particularly for near-term spending proposals. Finally, while we should find bipartisan ways to reduce the tax gap, it's worth noting that our nation has a relatively high and stable voluntary tax compliance rate. According to the most recent IRS data, about 84% of taxes were paid voluntarily and on time. After enforcement efforts and late payments were taken into account, about 86% of taxes were paid. Tax compliance levels remain substantially unchanged since at least the 1980s. There's not one solution to solving the tax gap or one type of taxpayer responsible for it. Reducing the tax gap requires a comprehensive strategy and effective execution from the IRS and appropriate safeguards and accountability to taxpayers. We have an excellent panel before us. Thank you so much for your testimony. Thank you all for being here, and I look forward to having the opportunity to engage with you in some questions. Mr. Chairman, I yield back. Thank you.
Thank you very much, Senator Thune. Look forward to working with you on solving this problem. And I am told, speaking of solving problems, that we have solved the problem of Mr. Johnson's connection. Is that true? Okay, we're good to go. Let me ask our first witness, now our last witness, Barry Johnson, the Acting Chief of Research and Analytics for the IRS, to make his statement.
Good afternoon, Chairman White House, Ranking Member Thune, and members of the subcommittee. Can you hear me?
Yes.
Super. I apologize for the technical problems. My name is Barry Johnson, and I'm the IRS's Acting Chief Research and Analytics Officer. I appreciate the opportunity to testify today to discuss my office's work on the tax gap. I direct the Office of Research, Applied Analytics and Statistics, or RAS, within the IRS. We support effective and efficient tax administration by providing strategic research, analytics, statistics, and insight to the IRS business units to inform their decision-making and increase innovation across the agency. One of the functions of the IRS is to oversee data collection and methodology used to measure the tax gap. As you've heard already, the most recent IRS study of tax gap was released in 2019. It covered tax years 2011 through 2013 and included methodological improvements that resulted in updates to earlier estimates. The study estimated the average annual gross tax gap for that period was $441 billion, and that the voluntary compliance rate was 83.6%. We are in the process of preparing a new study on the tax gap covering tax years 2014 and 16. It also will include projections up to tax year 2019, the last full year for which we have data. We expect to release this report early next year. The gross tax gap estimate of $441 billion does not account for the revenue brought into enforcement activities, such as audits and document matching, as well as late payments. After factoring in these efforts, the average net tax gap for 2013 is estimated at $381 billion. When looked at by mode of noncompliance, the tax gap can be divided into 3 components: non-filing, or not filing required returns on time; under-reporting, or not reporting one's full tax liability when the return is filed on time; and underpayment, or not paying by the due date the full amount of tax reported on a timely filed return. By far the largest component of the tax gap is underreporting, representing $352 billion of the $441 billion total. Individual underreporting comprises $245 billion, while employment tax represents $60 billion, corporate taxes $37 billion, and excise taxes $1 billion. The report confirms an important point about the tax gap. The compliance rate is very high for income that is subject to third-party information reporting, and higher still when you have withholding. The net misreporting percentage was just 1% for amounts subject to substantial information reporting and withholding, and it was 5% for amounts subject to information reporting without withholding. The misreporting percentage jumped to 55% for income not subject to any information reporting or withholding. While the IRS's tax gap methodology has been deemed the gold standard by tax administrators around the world, we recognize that the lag between the focus years and the release of the estimates reduces the utility of some purposes. We're developing an improved methodology we believe will produce more timely estimates. Preliminary research using this methodology grossed up 2011-13 estimates suggests that the gross tax gap for tax year 2019 would be approximately $600 billion. We also know that our current methodology primarily captures known factors that contribute to the tax gap based on actual examination activity, but may not include emerging issues, issues not disclosed during examinations, certain international issues, and issues that are concentrated in a relatively small portion of the highest income population. Recently, researchers explored two such factors used by the very wealthy: offshore accounts and pass-through business entities. Using the findings from this paper, we estimate that underreporting from these sources would add about $33 billion to our 2011-13 tax gap estimate, or about $50 billion in tax year 2019. My written testimony notes several ways the IRS is using data and analytics to improve IRS processes. To ensure that we direct our scarce resources to the most important opportunities, Doug O'Donnell, Deputy Commissioner for Services and Enforcement, and I co-chair our Data Analytics Governance Board. We've created a small innovation lab that brings together subject matter experts and data scientists to develop solutions to the highest priority cross-cutting challenges. To date, we have created new tools, techniques, and outreach strategies to help reduce tax gap and increase voluntary compliance. For example, working with the Taxpayer Advocate Service, we recently developed a new online educational materials on employment taxes, and are testing a soft notice intended to nudge businesses to send in a payment when they appear at risk of becoming non-compliant. Despite limited resources, the IRS is demonstrating our ability to better use data and analytics to modernize processes and reduce the tax gap. Additional resources to scale up these efforts would enable our hardworking, dedicated staff to make even more progress. Chairman Whitehouse, Ranking Member Thune, and members of the subcommittee, this concludes my statement, and I'll be happy to answer your questions.
Thank you so much, Mr. Johnson, and my apologies for the technical difficulties. Let me ask you, even the conservative IRS estimate of a $441 billion annual tax gap is more than honest taxpayers ought to tolerate, and Commissioner Rettig has testified that it may be as high as $1 trillion. How do you think the international tax gap fits into that discrepancy between $441 billion and $1 trillion?
We don't have, the tax gap estimates include some international activity, but not all. So in the estimates that we've been talking about this afternoon, we measure international activities by domestic tax return filers in the general estimates. We do not include activities from taxpayers with addresses abroad and businesses, foreign businesses, in the tax gap estimate, mainly because of the difficulty of trying to collect data using our standard classical statistical methodology for those estimates. We do hope that with the new methodology I mentioned that we'll be able to address that in the future. I think that the research I cited gives some insights into the magnitude of money that is overseas. We've done some preliminary analysis of the factor reporting for 2017, and we find that there are $3.7 trillion in assets that are abroad, and 56% of those, or $2 trillion of that, is located in what the OECD would consider to be tax-having countries. So we think that the tax gap attributable to international activities, specifically overseas accounts, could be quite large.
Is Inspector General George correct that the IRS, I'm quoting him here, has not developed a reliable estimate of the international tax gap?
We have not produced a separate standalone estimate of the tax gap. That's true. And that's partly because it's difficult to define what is even meant by.
I see that it's not easy, but I think it's important to nail down the starting place that we're at right now. Mr. Johnson, outside research has suggested that U.S. citizens hold as much as $1 trillion in offshore tax havens. Do you think that that is a reasonable estimate, or could the number be larger than that?
Based on our estimate using the 2017 factor reporting, it looks like that number would really be about $2 trillion, so twice that.
$2 trillion. Okay, well, thank you. Question for Commissioner Rosati. You described gaps in income not reported that need to be filled. Your testimony describes the importance of filling gaps in income that is not reported. Are there some fairly simple ways that we could help the IRS fill those gaps?
Well, we have proposed a method to do that, which would be one additional 1099 report on money in and money out of certain financial accounts, which we think would be covering basically the and we also suggested that be limited to certain taxpayers, mainly upper income taxpayers and flow through businesses. We believe together with the other information the IRS has and with the new technology, that would go a long way to closing the gap. I do point out that even though we estimated our total revenue gain higher than others at $1.4 trillion, that's only 19% of the total over the 10 years. And so my feeling is that with the information reporting, the technology, and the resources, that is not an unreasonable goal for a 10-year period.
And will you help us define whatever we may need to do legislatively or by way of oversight to make sure we close that gap?
Mr. Chairman, I would be delighted to. I've submitted for the record a rather lengthy document that describes some of our proposals. But those are just a starting point. I mean, we're just private citizens here, but we're trying to help as best as we can.
So one thing I'll note as I close out my questioning is that we've heard testimony today that 36% of the missing tax revenues of the tax gap, 36% of that comes from 1% of the taxpayers, and it comes from the 1% of the taxpayers at the top, the high income at 1%. And yet the county with the highest audit rate in the United States is a poor, mostly black county in Mississippi, where over half of the taxpayers claim the Earned Income Tax Credit, and median annual household income is $26,000. I will now turn to Senator Thune, but before I do, let me read off the list that we have right now of senators. We have Senator Thune here. We have Senator Brown would be next on the web. We have then Senator Grassley, then Senator Warren, then Senators Portman, Daines, Stabenow, Cortez Masto, and Carper. Senator Thune.
Thank you, Mr. Chairman. And I'd be interested in the IRS's answer to your observation about the area lower income that gets the greatest attention from the auditors. I think that'd be good for him to answer. Ms. Olson, your written testimony clarifies important distinctions about the tax gap not equaling tax evasion, or how the tax gap does not equal tax evasion, I should say, and how conflating the phrases can lead to wrong impressions and possibly incorrect estimates about the tax gap. Could you tell us more about the distinction between the tax gap and tax evasion and why it's so important to be clear with the terminology?
I think that there are many causes for the tax gap, which can go from tax law complexity to even procedural complexity, people not understanding what the IRS is requiring of them in terms of submitting documentation. It can go to pure evasion, that asocial form, and it can even be a protest against how money is being used. There are any number of reasons, and if you treat every single taxpayer the same way, you really risk converting compliant taxpayers into non-compliant taxpayers because they feel like they have been treated badly, poorly.
According to the latest official IRS estimates, and this was alluded to in your panel's testimony, the gross tax gap is $441 billion. I think, Mr. Riccati, you said that. That's before the late payments and enforcement, and after the payments and enforcement, the net tax gap is $381 billion. And again, pointing out earlier this year, the IRS commissioner did speculate at a finance committee hearing that the tax gap could approach or exceed $1 trillion, a figure that many have taken as a factual data point. For example, on the day of the hearing, the New York Times ran a headline stating tax cheats cost the U.S. $1 trillion per year, IRS chief says. Even with the rise of virtual currencies and other changes in the economy, these numbers obviously don't square. Mr. Johnson, could you clarify the official IRS estimate of the tax gap?
Yes, sir. The official tax gap estimate is the $441 billion gross tax gap that we discussed already today. That relates to the tax years 2011 to 2013. I think the IRS Commissioner was updating that to the President, and I testified earlier that if we do that with just the gross tax gap estimate we discussed, we get to a tax gap estimate of $600 billion. If we add in a little bit extra that was identified as uncut, undisclosed, or uncovered in the current estimates of $50 billion, then we're up to $650 billion. Factoring in other issues related to the changes and the structural changes in our economy that have taken place since 2013, the incredible rise of cryptocurrency, the growth of the platform economy, tax schemes like syndicated conservation easements, microcap insurance, I think we would be looking at adding a significant additional amount to the potential tax gap. Also, we have to keep in mind that over the last 10 years, IRS audits have fallen. We know that some of the benefits of IRS audits is that there are direct consequences. We collect more money, but there are also indirect consequences. Others perceive that their risk of being audited are higher, and that might cause them to disclose more information when they're reporting their income and taxes. The fact that IRS audits have fallen, and it's been very well publicized due to its budget cuts, has also been having an impact on that deterrent effect. So I think when we add all these things together and think about what the tax gap might be today, I don't think that it's unreasonable to speculate it could be as high as the Commissioner's estimate. And that's even before we think about illegal sources of income.
And when you talked about the breakdown of the $381 billion, I think you said that $245 billion of that is on the individual side. Did I get that right?
That's correct.
Okay, so $245 billion. In most of this you suggest is underreporting. Give me some examples of that. I understood what the chairman was saying about some of this being offshore accounts that people aren't reporting. Wealthy folks. Do you have the components or how you compose the $245 billion on the individual side?
Sure. I believe I provided a copy of the tax gap map in the written testimony. We estimate that business income makes up $110 billion of that. Non-business income, $57 billion of that. Credits that are misreported, 42 billion. I'm sorry. Income offsets, $20 billion. Filing status, misreporting, $5 billion, and other taxes, about $1 billion.
Very, very quickly, Ms. Olson, as a former IRS watchdog, what do you think about the significant higher guesstimate and its methodology?
I am very disturbed about guesstimates about the tax gap. I think that sends a message both to IRS employees that there are lots of people out there cheating, and so whomever they see, they may view as that. I think that there's need to do really responsible work. It sounds like the IRS is trying to do that with offshore, but I think we should wait to hear what the actual rigorous methods are. The article by the NERB has not been peer-reviewed yet, and so I think all of these things need to be taken very carefully.
Thank you, Mr. Chairman.
Thank you very much, Senator Thune. We will now turn to Senator Brown, and after Senator Brown, if Senator Grassley is not here, we'll turn to Senator Warren.
Thank you, Chairman Whitehouse, and Senator Thune, Ranking Member. Thank you for this hearing. The 2017 tax law, as we know, gave a huge windfall to owners of so-called pass-through businesses, contrary to what my Republican colleagues say. These are mostly not small businesses. They're more likely to be hedge funds, real estate interests, and companies like the Trump Organization. The 2017 tax law gave these wealthy taxpayers a huge tax cut. To make matters worse, the IRS isn't funded and staffed to effectively audit them either. So, Commissioner Rosati, your proposal, explain to us, if you would, how it will help the IRS move to help them more effectively target pass-through businesses, the entities that largely drive the tax gap.
Yeah. So, yes, Senator Brown. So I think one of the observations that underlies our proposal is that over the last, even I would say 40 years, the fraction of business income that is earned in pass-throughs, which was relatively limited, very limited a few years back, many years back, has become as large as all the corporate income combined. So it's a large sector. And, honestly, the IRS programs for compliance in the sector have not kept up. So that what we proposed is really three things, the same as other areas. Some additional information reporting, really one additional information report. Secondly, the technology to make use of it, because right now, even where the IRS has information, for example, K-1s report income from partnerships to individuals, but the IRS has no technological ability to use that. So that's almost $2 trillion of income that is reported but is not checked. And finally, of course, I think use of that information to follow up when there are deficiencies that are identified. Because right now, even though the Congress has given the IRS some additional authority a few years back, the ability of the IRS to use that and to audit rate is very, very limited. There's essentially negligible auditing in that sector. So those are some of the proposals that we think could help to identify underreporting in that sector.
Thank you, Commissioner. I can think of no other better way to undermine faith in our democracy than to tell working Americans that there are really, when it comes to paying taxes, two sets of rules. One for people like them who pay their taxes, and another for the 1% that everybody in this panel is about, as mentioned, who don't pay close to their fair share. If that is bad enough, we obviously have serious infrastructure needs that people here want to pay for and pay for with real tax dollars. My other question is, in 2 minutes, Olson, when asked about the ITC, does the ITC comprise, I heard the Chairman's question about Mississippi, or comment, does the ITC comprise a significant part of the tax gap?
Sir, no. It's about 3.9% of the tax gap if you estimate it at $441 billion, and if you take the Commissioner's estimate of $1 trillion, it would be about 1.7%.
Spread out over lots and lots of taxpayers, of course, in the ITC. Would we see fewer improper payments in the ITC returns if the IRS had the authority to establish minimum competency standards for paying tax preparers?
I think that is a significant provision that would reduce noncompliance in that area, since so much of the returns are prepared by paid preparers and even ghost preparers, people that don't sign returns but are actually getting paid. And there's where you have the highest error rates.
Thanks, Olson. Something presidents of both parties have proposed in their budget, Congress needs to enact it. With the expansion of the BITC and the child tax credit, it's critical that eligible filers take advantage of these, of all of these credits, which support them, support workers, support families, and it's a very high priority of this Congress. Chairman Whitehouse, thank you for allowing me to be part of this hearing today.
Thank you very much, Senator Brown. We'll turn now to Senator Grassley, followed by, shift in order, Senator Carper, and then Senator Portman. So Grassley, Carper, Portman.
Ms. Olson, thank you for your long service. Before I answer my question, I'd like to acknowledge your good work. One of the difficulties of the IRS is targeting its limited audit resources at bad actors while not unduly burdening honest taxpayers. In short, avoiding no-change audits. The IRS whistleblower program has proven to be an effective means of identifying and examining non-compliant taxpayers. As a result, the IRS whistleblower program provides significant bang for the buck. This also benefits honest taxpayers since they are less subject to hassle from the IRS. What are your general thoughts on the whistleblower program? Do you agree that a robust whistleblower program must be a part of any effort to reduce the tax gap?
I think the whistleblower program is uniquely designed in the area of offshore. That is where you will, through whistleblowers, get information that you might not be able to achieve elsewhere and obtain elsewhere.
So it is a useful tool.
Yes, absolutely.
Yeah. Mr. George, I've been a proponent of the IRS private debt collection program as one means of closing the tax gap. The program has proven able to collect hundreds of millions of dollars annually that otherwise would go uncollected. However, as mentioned in your testimony, one issue that hinders the program is the old age of the accounts assigned to the program. To address this issue, the Taxpayer First Act shortened the time period for when accounts may be assigned to the program after assessment by over 1 year. This shorter timeline became effective beginning 2021. Mr. George, can you confirm whether the IRS has implemented this updated time frame for assigning accounts to the program?
We know that they are taking steps now, Senator, to implement the changes that are required. But to the extent that they've completed those, I would have to get back to you.
Okay, please get back to me. Also to you, Mr. George, I've long been concerned about the amount of time IRS employees spend on union activity at taxpayers' expense. Sensible standards for granting and using taxpayer-funded union time were imposed during the Trump administration. This resulted in about a 26% drop in the number of hours Treasury employees spent on union time. This equates to the annual workload of about 61 full-time employees. If we're serious about closing the tax gap, a top priority should be ensuring IRS personnel are used effectively. Now, the current administration repealed the Trump-era limitation on this activity. Mr. George, can you speak whether Treasury and the IRS have reverted to the pre-Trump policies with regard to union time?
That I cannot address, Senator. No, I don't have information regarding that. We'll look at it, and if we...
Can you submit it to me in writing?
I most definitely will.
Yeah. And my last question for you, Mr. George, and for everybody, I'm concerned by a finding in a recent report issued by your office titled, quote, high-income taxpayers who owe delinquent taxes could be more effectively prioritized, end of quote. According to this report, IRS failed to assign 3,185 high-income taxpayer accounts to the private debt collection program despite meeting the program's eligibility requirements. This suggests that the IRS is not making full use of the private debt collection program. So my question, do you have any suggestions on how the IRS could improve the process it uses to identify and assign eligible accounts to the program?
Senator, we have reported that the IRS does receive very dated tax accounts or provides those to the private debt collection organizations. And the longer, as you well know, you wait to provide those tax accounts to these private debt collectors, the less likely it is that they're going to receive anything from it. That said, even though by general standards, the percentage of accounts that are given to private debt collectors is below industry standards in terms of the recovery rate, they are still, the private debt collectors, receiving more money in terms of collecting it from people who owe it than the cost that it is being charging to the government. So giving more quickly accounts for these private debt collectors to address would help address that problem, among many other factors that could happen.
Thank you, Mr. George. Thank you, Mr. Chairman.
Thank you very much, Senator Grassley. We'll turn now to Senator Carper, followed by Senator Warren. Senator Carper. Senator Carper just logged off. Senator Warren. Senator Stabenhauer on? Senator Carper.
Mr. Chairman?
Yes, proceed, Senator Carper.
Thank you so much. I want to thank you, and I want to thank Senator Thune for convening this series of important hearing. I'll never forget, as a congressman a million years ago, hosting a series every year. I hosted a workshop, budget workshop, where we invite Delawareans from all walks of life to come to town hall meeting. We'd spend a couple of hours together trying to figure out how to balance the budget. And one of those meetings, I suggested maybe that raising revenues was part of the solution. One lady sitting in the back room said, "I don't mind paying X amount. I just want to make sure that everybody else is paying their fair share." I'll never forget that conversation. But for years, our former IRS Commissioner John Koska, who's someone I have enormous respect for, and others do too, he testified before the Senate Finance Committee about the need for increased resources for additional personnel, updated technology, year after year after year. Unfortunately, much of his testimony fell on deaf ears. The IRS budget has shrunk, I think, since 2010 by something like 20%, and the number of revenue agents who specialize in evaluating the complex returns of high-income individuals and corporations has decreased, I'm told, by nearly 40%. And last month, our colleagues will recall that our current Commissioner Chuck Rettig reiterated the need for additional resources for enforcement. But providing additional appropriation funding to the IRS just may not be enough. It's certainly part of what's needed, but an effective enforcement structure at the IRS is going to require sustained and longer-term funding and certainly predictability. Last week, 5 former IRS commissioners, including the Mr. Presiding, penned an op-ed in, I believe it was the Washington Post, and in support of President Biden's IRS plan. Mr. President, thanks for joining us here today. What the components of the President's plan for the IRS would you think be most effective for Congress to adopt as we address tax gap?
Thank you, Senator Harper. Yes, I think all 5 of us commissioners have discussed that editorial before we agreed to sign it, and we think that there are 3 parts to the administration proposal which are together what makes for the effective thing. There is a need for some additional information reporting to fill some gaps in the types of income that is reported. Secondly, the administration proposal does provide for funding on a long-term basis for technology and for rebuilding the IRS workforce. And I think those 2 latter things are really why it's so important to have a sustained effort. It's not possible in a case like the IRS to put a one-time appropriation and frankly, you could overdo putting money in too quickly and not be able to get it used effectively. So I think what is most effective about the administration proposal, and what we certainly support, is the idea of funding over a 10-year period that would be reasonably assured, but not overdone in any one year. Our own estimate that we've made independently is that about a 6% a year increase that would cover both technology and staffing would be most effective and could be readily managed.
Thank you, Commissioner. Second question I have deals with fiscal responsibility and IRS enforcement. I think I'll direct this to Mr. Johnson and to General Russell George. Part of maintaining fiscal responsibility is making sure we have ample revenues, as we all know. And this includes collecting the taxes that are currently owed under the law. Commissioner Rettig, who was before us a month or so ago, has estimated that for every additional dollar of enforcement funds, we could bring in somewhere between $5 and $7 in additional revenues. That seems like a pretty good return on investment to me. And I would ask Mr. Johnson and Mr. George, how would robust investments in the IRS enforcement represent an efficient use of taxpayer dollars and raise revenues in a way that improves our long-term fiscal outlook? Mr. Johnson, Mr. George.
Thank you. I can comment on how we produce those revenue estimates. The return on investment estimates that are used are produced in my office in conjunction with the Chief Financial Officer's office. We look at the historic revenue collected by the enforcement staff over the most recent 10-year period, putting more weight on more recent years because those activities obviously reflect current uses. And as you noted, the ROI does vary a bit between the different types of taxpayer work that we do, but that on average it is about 4 or 5 to 1. And for my money, I would be happy to have any investment that returned 5 to 1 as its average return.
I think we all like a piece of that action. Mr. Johnson, Mr. George.
And Senator, I would give the following example in response to your question. The IRS's high income threshold for underreporting is around $200,000, and its threshold for non-filing is $100,000. Average revenue agent productivity on incomes above $10 million is over $4,500 per hour of revenue agents' times, as compared to a few hundreds of dollars per hour in audits of taxpayers with incomes between $200,000 and $400,000. The bottom line is, if you give the money so that the expertise can aim towards the group that is in a position better to manipulate their taxes so that their responsibility to the government, I'm not saying intentionally hidden, but that the avoidance versus evasion argument is addressed, the IRS could get a better return on investment for all the dollars that it expends.
Thanks. Mr. George, your words remind me of my words at commencement classes sometimes when talking to graduating seniors. I say at AMI there's more room up there, and probably Germany here as well. Our thanks to all the witnesses. It's also very nice to see you again. Nice to see you all. Thank you all for joining us today.
Thank you, Senator Carper. Next is Senator Warren, then Senator Stabenow.
All right. Thanks very much. Thank you. I'm glad we're focusing on the gap between taxes owed and taxes collected. I'm introducing a bill with mandatory funding, so the funding lasts year by year by year, so that the IRS can boost tax enforcement for wealthy individuals and for giant corporations, who are some of the biggest tax cheats. And I know that President Biden has a similar proposal. But funding isn't all that the IRS needs to do better enforcement. When a teacher sits down to do her taxes, she relies on a W-2 that tells her exactly how much she earned in wages. Her school sent her this W-2 automatically, and it sent a copy to the IRS as well. And this is called third-party reporting, and it helps the teacher fill out her tax return accurately. It also helps the IRS do its job, both by making it easier to verify incomes and by keeping people honest, because they know the IRS can spot it if they fudge the numbers. So, Mr. Rosati, I want to run through a few examples with you if we can. If you own your own law firm, is there as much third-party reporting on how much you made as there is for the teacher?
Well, most law firms are organized as partnerships, and there is some reporting, but it's quite limited on partnerships, whereas, of course, wage earning is 100% reported.
Okay. And what about if you own a giant beachfront mansion and you sell it for a lot more money than you bought it? In other words, you made a capital gains income. Is the IRS likely to know exactly how much income you received?
Well, of course, you're required to report it as a capital gain, but there isn't any third-party reporting on that kind of a transaction.
So the IRS has no independent verification of it automatically?
Not unless it does an audit.
Okay. And what about if instead of selling your mansion, you decide to post it on Craigslist and rent it out? Is the real income you get likely to be automatically reported to the IRS?
same answer. I mean, you're required to report it, of course, but there is no third-party reporting on that transaction if you just rent the property yourself.
Okay. So here's the thing. The kinds of income that the IRS has the least visibility into are the kinds of income that are overwhelmingly concentrated among the very richest taxpayers. So if you're a teacher, a construction worker, a bank teller, nearly all of your income comes from wages, and that information is automatically reported to the IRS by your employer. But if you're someone, say, in the top 1%, most of your income is coming from business and capital income, and the IRS is counting on you to follow the honor system when you file your taxes. So, Mr. Rosati, as a former commissioner of the IRS, you saw this firsthand. Let me just ask you, do you think the honor system is working?
Well, it works to a certain extent because there is a great deal of income that is not reported, that is third party, that is still reported by taxpayers. But it is also true, I think, as Mr. Johnson noted in his report earlier, that the reporting level on income that is not third party reported is as low as 50% on the kinds of income that you identified in your example.
Okay.
So there is a big difference.
So I think the conclusion we can draw is that strengthening third-party information reporting would obviously help people file their taxes more easily and more accurately, and frankly make it harder for wealthy tax cheats to get away with hiding their income. The top 1% fail to report, I've heard, more than a fifth of their income. You're saying maybe as much as half. And more than a third of all unpaid federal income taxes. That cost us an estimated $175 billion in tax revenues last year. So that's why my legislation takes Mr. Rosati's advice and requires banks and other financial institutions to provide the IRS with information on account holders' balances. It would fill in the holes that allow the richest taxpayers to underreport their income and skip out on the taxes they owe. Strengthening information reporting as well as providing protected and sustained IRS funding would ensure that we focus enforcement on the biggest fish. This is about making our tax system fair and about raising the revenue that we need to create opportunity for every kid in America. Thank you, Mr. Chairman. I yield back my time.
Thank you very much, Senator Warren. We'll now turn to Senator Stabenow and then to Senator Daines, who has joined us in the hearing room. Senator Stabenow.
Well, thank you so much, Mr. Chairman. This is such an important discussion, and I know that folks in Michigan listening to this right now are certainly scratching their heads or maybe very mad about what they're hearing in terms of the level of scrutiny on their taxes as middle-income working people versus someone who is very, very wealthy. But so let me just start by saying a typical Michigan family goes to work, they earn their pay with their taxes withheld, they're sent a W-2 every year, the IRS knows exactly how much money they make and how much money they owe. But when, as we're talking about today, when you look at households who have more money, more assets, leading to more capital gains income and pass-through income, there's shockingly less oversight by the IRS. And so it's important to note that we're not talking about how many taxes a wealthy should pay. We're talking about how much they should pay, what they already owe, which I think is really important. And so I know today we're looking at whether it's Commissioner Redding's estimate of $1 trillion a year in a tax gap, or $600 or $800 billion or $2 trillion. Any of that pretty much adds up to a lot of money. And when I think about the things that we could do with that, like extending the child tax credit to permanently lift children out of poverty, or fix our roads and bridges, or critical investments in education and small businesses and manufacturing, and on and on and on. I think we hopefully would all agree that the wealthy should be paying their fair share. So, Mr. Johnson, my question first would be, can you talk a little bit more about why the top 1% account for a disproportionate share of the tax gap and are more likely not to pay their taxes for whatever reason than the bottom 50% of Americans.
I think the best way to think about this is to think about the statistics we talked about earlier, and that is that when we have information reporting and withholding, the reporting of that income is 99% accurate. When we have information reporting without withholding, that information is reported with about 95% accuracy. But when we have income that doesn't have any information reporting at all, that's reported with an accuracy rate of about 45%. And so I think the answer to your question is that for those taxpayers whose income is primarily made up of income that's got substantial reporting and withholding, those folks are going to are more likely to be compliant. But whereas people who have more of their income coming from sources where there isn't third-party reporting, that's where we see higher levels of non-reporting. And I think that's consistent with what we've been hearing from most speakers.
Yes, absolutely. Thank you. Important for us to consider here, that's for sure. And Mr. George, one other thing is, as the chairman was talking about, and as was depicted in a ProPublica report, the highest audit rates are located in predominantly black and brown, lower income households in rural counties. Yet the number of audited tax returns of millionaires has fallen by 72%, down from 40,965 millionaire audits in 2012 to just 11,331 in 2020. Similarly, nearly 2 out of every 3 of the 755 largest corporations in the country, those with over $20 billion in assets, were not audited last year. We know that tax evasion using offshore accounts and pathway entities are techniques mostly employed by the top 1%. Yet the IRS underestimates systematically tax evasion at the very top to the tune of, we've heard about, $175 billion annually. So, Mr. George, we have the data, we understand what's happening. Why is the IRS unable to target these individuals who are deliberately evading the taxes that they owe, but lower income individuals with less resources, less recourse, are subject to audits and costly fees at higher rates from errors or unintentional noncompliance?
Senator, there's a number of factors that come into play here. Everything from, of course, a lack of resources to where some of the tax examiners are located, physically located, who can do more complex tax returns versus less complex tax returns. As it relates to the very high income taxpayer, you need someone to go in and literally, physically look at information as it relates to that return. Whereas in some very simple tax payers, in terms of their returns and issues relating to that, it could simply be a correspondence audit, a letter sent to them. And so, when you look at the actual numbers, a lot of the IRS examiners are in areas that have a preponderance of low-income taxpayers. It really it's interesting that the IRS, you would think, would be able in this day and age to do things electronically or in other ways that would not require a physical presence. But unfortunately, in many instances, that's not the case.
Well, we certainly could do better, right? I mean, what you're describing doesn't make any sense, right? Because it doesn't make any sense to anybody listening to this. Yet even those who would benefit would have trouble really being able to explain why this is a good idea. I mean, we're saying if you make more money and your tax returns are more complex, more likely you're going to get out of paying your taxes, right, than somebody who's got a simple form, working hard, has withholding, and is just going to work every day and paying taxes. So thank you, Mr. Chairman, for this.
Thank you very much, Senator Stabenow. We'll turn to Senator Daines, who's here in the room, and then Chairman Wyden will be recognized next.
Great.
Senator Daines.
Thanks, Chairman Whitehouse. I think it's very safe to say that all Republicans and Democrats oppose tax evasion and support taking steps to close the tax gap. Congress supported President Trump's budget proposals to increase IRS funding as well as the enforcement resources, which incorporated the Congressional Budget Office's recommendations. I do believe there is room for further bipartisan cooperation to address the tax gap. However, I do have some concerns about President Biden's proposal to increase the IRS budget by an unprecedented $80 billion over 10 years. I'm even more concerned that the administration is using a highly questionable estimate of some $700 billion in revenue raised as a key offset for its latest $2 trillion infrastructure package. I've not seen the modeling that explains exactly how the $700 billion in net revenue will be raised, and to my knowledge, nobody outside the administration has either. Ms. Olson, former IRS Commissioner Koskinen recently stated that he's not sure the IRS would be able to use that $80 billion effectively. Would you agree with that statement?
I think that it will be very hard for the IRS to ramp up that quickly. What Commissioner Rosati has suggested, is a sustained increase over their basic, what they need to just keep the lights on and do their basic job. And that set aside over a sustained period of years to bring on the technology and the skilled employees, different skill sets, to be able to use that technology wisely. And then the last thing is it needs continued congressional oversight to make sure that those dollars are applied well. But it needs to be a level increase over a sustained period of years, not a really huge ramp up. It won't be able to do that well.
Ms. Olson, thanks for your thoughtful answer. The follow-up on that would be that the CBO estimated last year that an additional $40 billion in funding for the IRS would result in a net revenue collection of $63 billion. $40 billion invested, $63 billion collected. Could you explain how doubling that funding level to $80 billion would magically produce an additional $637 billion in net revenue?
I don't know that. I'm not an economist, and I don't know what underlies any of those numbers. If you're focusing on the highest income, so you may get a greater return on investment there than just the basic level of return of investment of 4 to 5, that may be something. But again, I can't answer where those numbers come from.
Yeah, we're just pointing the gap between $40 billion and $63 billion. $40 billion invest, $60 billion back from CBO, and the administration suggesting $80 billion would give us $637 billion. That's a huge, huge disconnect. Mr. Johnson, some of my colleagues across the aisle like to state that low-income individuals are audited at higher rates than high-income individuals. We had Commissioner Rettig before the Finance Committee in mid-April. I think he did a pretty good job of responding to this charge, but I think it's worth highlighting that once again. My question, Mr. Johnson, is are you more likely to get audited if you are a low-income taxpayer or a high-income taxpayer?
Thank you for the question. I think you're asking what the audit rates are for those different taxpayer groups, and the audit rate for low-income taxpayers is lower as a percentage of all taxpayers in that category than the audit rate for higher income taxpayers, looking at total positive income.
Yeah, I just wanted to dispel this myth where we've heard some of my colleagues suggest that low-income individuals are audited at higher rates than high-income individuals. Of note, according to the IRS, for the record, high-income taxpayers, and this would be over $1 million, are audited at about an 8% rate, whereas earned income tax credit recipients are audited at about 1.12%. Just want to set the record straight on that data coming from the IRS. Mr. Chairman, thank you. I yield back my time.
Thank you very much, and I have the privilege now to turn to Chairman Wyden.
Thank you very much, Mr. Chairman, and thank you for scheduling a very important hearing and your long history of going after these kinds of cases and trying to protect taxpayers. What I'd like to do with our panel, we've got a terrific panel here, is better understand how the IRS
uses the tools at its disposal to enforce collection from repeat offenders. I don't believe we've talked about that yet, and what we're talking about is high-income non-filers with multiple years of unfiled unfiled tax returns. And 26 U.S. Code 7203 makes the willful failure to file a tax return and failure to pay federal income tax a crime. So what we're talking about is high-income individuals with multiple years of unfiled tax returns, and the agency recently estimated there were almost 50,000 high-income non-filers owing $7.1 billion in taxes with multiple unfiled returns for tax years 2014 through 2016. So my question is for you, Mr. O'Donnell, for cases involving high-income non-filers, people with multiple years of unfiled returns, has the IRS made any recent criminal referrals to the Tax Division of the Department of Justice for the willful failure to file a tax return or pay estimated tax?
Thank you, Senator Wyden. I am uncertain whether or not we've made any criminal referrals to the Department of Justice. I will certainly look into that and get back to you. But what I can say is that our revenue officers are hard at work out in the field ensuring that high-income non-filers that we're aware of are being brought into compliance, and we're using all tools available to bring them into compliance. Currently in this environment where it's very difficult to go out into the field, but our revenue officers continue to perform that work.
Well, respectfully, Mr. O'Donnell, I don't understand how one can assert that all tools are being used when we're talking about high-income filers, multiple years of unfiled returns, an estimate of $7.1 billion in taxes in just 2 years, and you're not aware of whether there were any criminal referrals to the Tax Division of the Department of Justice. So what I would like you to do is to furnish to Chairman Whitehouse and myself as chairman of the full committee why this is the case, and you said you weren't aware of any, because I just believe it sends a message that there's not much of a deterrent there. If there haven't been any referrals at all, and that's why we're going to need the facts, I would like that to be available to myself as chairman of the full committee, Chairman Whitehouse, within 2 weeks. Will you make that possible?
Yes, Senator. Well, and just to clarify my response, this is my second day in this role, and I'm not yet up to speed on that program, but I will certainly get there and be happy to provide the information that you've asked for.
Thank you, and I certainly understand that if you're new there, that it takes some time to gather all the facts, but I think you can get a sense of why I think this is a showstopper kind of question. Repeat offenders, enormous sums of money involved, so this is not somebody making a once in a rare instance kind of a mistake. We got to get on top of that, so we'll expect to get an explanation within 2 weeks about whether there have been any referrals, and if there haven't been, why there haven't been, and what's going to be done about it. Okay? 2 weeks.
Yes, Senator, will do.
Great. Thank you.
Thank you very much, Chairman Wyden. I think we have Senator Cortez Masto standing by electronically, and I would call on her if she is available.
Thank you, Chairman Whitehouse. Ms. Olson, let me start with you. You recommended in your testimony that the IRS could use data and technology not just to find those taxpayers who are non-compliant, but to help taxpayers ensure they get full access to the benefits that they deserve. In our last hearing with the IRS Commissioner, I raised that the Advanced Child Tax Credit portal should provide ease,
Senator Cortez Masto, we are having trouble hearing you in the hearing room. I don't know if there's a sound issue of some kind.
Let me try that. Is that better? Can you hear me okay?
That seems to be better. We hear you, and we'll restart the clock. Nope, still stuck. Your screen is not quite frozen, but moving very, very slowly. Senator Cortez Masto, we're being advised that you might turn off your video, and then your voice would be able to come through. Taking advice from me on a technological matter is not the wisest thing, but there you are, so it worked.
Better. Better. Can you hear me okay?
Yes, we hear you well. Proceed.
Wonderful. Thank you. Sorry for the technical difficulties. Ms. Solson, if you can hear me okay, you recommended in your testimony that the IRS could use data and technology, not just to find those taxpayers who are non-compliant, but to help taxpayers hold access that they deserve. In our last questionnaire, I raised that the Advanced Child Tax Credit should provide access for taxpayers who find them in unique situations, such as domestic violence survivors. So my question to you is, could the portal be designed to help domestic violence survivors get their Advanced Child Tax Credit?
Yes, absolutely. I think that because the marital status, the household status where the children reside will have changed by perhaps with the domestic violence survivors by the time that the last filed return has been filed, that the portal would first, there should be a portal to allow them to do a simplified electronic filing so that they can update their filing easily. And then also the change of circumstances portal should allow them to enter their change in marital status and also where the children are. And because it is likely that there would be a disagreement between the abuser and the survivor as to where the children are, there needs to be an appeals process, an expedited appeals process, so the survivor and others can come in and submit documentation to show and not have to, that where the children are, and not have to wait until the filing of the next year's tax return in order to get the advance credit. And there are procedures in the IRS, like the collection appeals process, where there's a 2 to 3 day turnaround, from the appeals officers when they get the case. And the benefit of that is it minimizes improper payments.
Thank you. Ms. Olson, thank you so much. I really appreciate that, because this is an area that we need to prioritize, and I know there was a way to get this done. I appreciate your comments. I'm going to submit the rest of them for the record. Thank you, everyone.
Thank you, Senator Cortez Masto. I believe that Senator Portman is holding, and I would call on Senator Portman if he's available.
Thank you, Chairman Whitehouse, and thanks to the panelists who come today. I feel like this is a reunion of sorts. Former Commissioner Rosati, thank you for your continued interest in tax administration and the work you've done over the years as Commissioner and since. And Nina Olson for your work over the years. I've loved working with you as well as a taxpayer advocate, and now with the Center for Taxpayer Rights. And Russell George, hanging in there as our IG for tax administration. Thank you, all three of you, for your service. My first questions are not going to go to the three of you, but to Mr. Johnson and Deputy Commissioner O'Donnell regarding the big issue here, which is the tax gap. I understand that's been discussed quite a bit today, so I won't belabor that, except to say that it is confusing seeing so many different predictions as to what the tax gap would be based on different enforcement options and different amounts of funds that could be provided. And I understand you've answered that today. What you haven't apparently answered as much about is your estimated revenues from improved enforcement. So I wonder if you could speak to that a little bit. There are various enforcement numbers out there. One from Larry Summers and Natasha Sarin estimate that a $100 billion investment, along with some other changes they propose, would generate more than $1 trillion in revenue over 10 years. That's the most generous one, I suppose. Can you all talk a little about what the limits are? In other words, if these predictions just get higher and higher, depending on how much more money you put into the IRS, and all of them are significant ratios, where is that balance? Where is the right enforcement leading to the right assistance on the tax gap?
So I can start. Thank you for the question, Senator. The estimates of revenue that my office produces are based on historic tax data. So we look over the last 10 years at the revenue that has been generated by actual workers working on groups of taxpayers that have similar characteristics. So we divide the tax filing community into, we call activity codes or groups, and we look at the revenue that's brought in based on the hour of work that the revenue officers do. The return on those, or the revenue raised by those officers and agents varies based on a couple of factors. First, on the complexity of the return, or the tax situation that they're examining, the experience that they have working. And so when we produce our revenue estimate of what the impact of an increased investment would be, we take into account the fact that for the first year or so of a new agent working in the field, would not raise very much money. And in fact, it would cost us a bit of money because we have to take someone offline to do training. And we recognize that for the first year, there's probably a loss on that person. In the second year, there's some revenue, and then by the third year, we believe that they're working at full capacity. We also recognize that as we audit larger numbers of cases or a larger percentage of cases in a particular activity code or group of returns, that the return on those cases is going to fall. If we're picking, and we hope we are picking the returns of the most egregiously non-compliant, and as we increase the number, we're going to be working cases that will have a lower dollar returns. And so that's also factored into our estimates that we produce for what the return would be on different kinds of investments. So
that's where the term diminishing returns must come from.
That's correct, right. Now,
that was a joke, Mr. Johnson. Diminishing returns.
Yes.
Yeah, well, look, I know last time Commissioner Ziding was before, or not Commissioner Ziding, sorry, Commissioner Reddick was before us. He explained about how the tax gap numbers were, still subject to some adjustment, and he specifically said that he's going to ask your research division to update its approach to determining the tax gap. Has that happened? Is the approach you're talking about today the new approach, or are you still updating your methodology?
We are in the course of updating the methodology. So we have been working for about a year and a half on a methodology that relies more on machine learning, or what some would call AI, on artificial intelligence, to make greater use of the operational audit data in looking at the tax gap. Traditionally, our tax gap estimates have been based on a statistical sample of tax return filings that then get a purposeful audit that goes, and it's just those returns that have been used for statistical estimation. We believe that by bringing in more of the operational audit data, we'll be able to produce estimates that are more timely and are better able to detect emerging issues. So while our current estimates, the estimates that are our official estimates, are based on tax returns that were filed in 2011 and 2013 and were audited in the years after that, the statistics we're going to put out next year will be partially based on a similar sample, but we'll also be using this new methodology to update those estimates to provide an estimate of tax year 2019 which is the tax year that we have almost all returns in for now, based on the way returns get filed with the IRS. So
at the conclusion of this new analysis and looking at your new methodology, will you be able to tell us what you recommend as the right amount of resources in order to maximize the optimal amount of tax revenue to close the tax gap?
That's not a decision that my office would make. We do hope to be able to provide information that would enable the business units and Deputy Commissioner O'Donnell to make those kinds of decisions. But we hope that the information will be able to
Deputy Commissioner O'Donnell, then, is that your goal to come up with some suggestions as to the notion of diminishing returns? At some point, you know, the return on the investment is not as great, and there's also the issue of personnel and the issue of taxpayer rights and just ensuring that it's done in a way that's appropriate. So, Deputy Commissioner, are you in a position today to say that you have a sense of what that optimal number might be?
No, Senator, I don't know what the optimal number would be, but I do know that the work that Mr. Johnson's team does to estimate the tax gap helps us understand where to deploy our resources. We know that those, and we heard from Commissioner Rosario on this, former Commissioner Rosario on this, that where there is opacity in income sources and there's low third-party reporting, there is likely to be less compliance, and that's where we would want to put additional resources. The precise number is not clear. We do know we're down 17,000 enforcement personnel over the past decade, and that we believe is some parameter where we would want to get to.
Yeah. Okay. Well, that's certainly I think you'll find bipartisan support for some of these efforts to increase personnel and to target these resources appropriately. Is Commissioner Rosati, former Commissioner Rosati, still with us?
Yes, I am. Right here.
Charles, I can't see you, so I'm concerned.
Okay, well, I'm here in the hearing room, Senator.
Good. Well, let me say, first of all, it's good to hear your voice, ladies, and I hope to see you visually here in a minute. But talk to us for a minute, if you could. I'm at the end of my time. I'm sure I appreciate Mr. Chairman indulging me. But on the reporting, I agree with you. More reporting is a good idea generally. On the other hand, there are limits to reporting. It's kind of the same balance we talked about. I remember in 2011, expanded Form 1099 for the Affordable Care Act, was repealed. It was very bipartisan because although it was a component of the health care law, President Obama knew that it imposed excessive burdens on small businesses. And my question to you is, I guess, can you tell us, is there a way to improve reporting that would have a measurable impact on enforcement while still protecting taxpayer privacy without being overly burdensome?
I actually think there is, Senator, and that's something that I and several colleagues have been working on for a number of years. And I've laid it out. It basically would be one additional 1099 on certain financial accounts that would basically backstop all the other 1099s. As it is now, there are actually 22 1099s and 3 billion 1099s reported. So everybody's getting a lot of 1099s. The trouble is that there's some just significant holes in the less visible kinds of income. And the difficulty is that in the past, when I was commissioner, it actually wouldn't have been possible to do what I'm suggesting today because the technology did not exist. I could get to you and tell you, I actually tried some experiments and they didn't work because the technology was just too rule-driven and too specific. But today, you have technology, as actually Mr. Johnson said, that can essentially do part of what a revenue agent would do. I mean, not all of it, but some of it. And that would allow you to use new kinds of information that's not available today. So while I think all of the discussion about productivity and scaling up audits is meaningful, I actually am not suggesting that you could make a huge difference in the tax gap, no matter how well you scaled up audits. I really think it's the combination of new kinds of technology using all the information the IRS has, supplemented by audits, that actually would make the big difference.
Great. Well, I appreciate that perspective, and I hope you'll continue to work with us as we try to figure out the best way forward here. Again, it's good to have you before us, and thank you for your continued commitment to trying to make the IRS work better. You did that when you were a commissioner. We appreciate you doing it today. Thank you, Mr. Chairman.
Thank you, Senator Portman. We appreciate very much the effort at tax humor, which is not a very well-known category of humor, but I think point of diminishing returns set a pretty high bar within the category of tax humor. So you were entitled to some extra minutes there. Let me, ending on that note, let me thank all of the witnesses. Let me actually ask Mr. George, if I may, Inspector General George, for one clarification. Your testimony today said that as of 2018, the IRS, I'm quoting you here, the IRS had taken virtually no compliance action to meaningfully enforce the Foreign Account Tax Compliance Act. That was as of 2018. It's now 2021. Do you have any update from that 2018-based observation?
While I would never say that the IRS has done absolutely nothing to advance the implementation of that, they are lacking some very basic tools. And one of them is the ability to literally have taxpayers and the entities that they utilize overseas provide information, taxpayer identification numbers, for the IRS to be able to match the information the entity has versus the information the taxpayer has provided or perhaps has not provided. And we're literally talking about Social Security numbers in many instances. The IRS has done a tremendous amount of work working with nations across the globe to initially get this program off the ground, but what the most basic thing lacking, again, is the ability for the IRS to necessarily match up the information that it receives and, again, may not receive from one party or the other. So a light needs to be placed under the IRS to get them moving on that one, sir. And it's, in my book, low-hanging fruit.
Okay. So some progress has been made, but not enough to be able to say that they've got it covered. We need to continue to work on FATCA compliance.
Correct.
It's too bad we couldn't put an extra T on it. Then it would say Fat Cat, which would be such an appropriate acronym for it. There, that's my effort at tax humor. Let me thank all the witnesses. This has been really, really helpful for us. This is the first hearing of this Finance Subcommittee on tax and IRS oversight under my watch, and I hope that all of them are as successful and have as distinguished and helpful a panel as we have had today, and have the same level of input and engagement from all of our distinguished members. So with all of that, do we keep the record open for?
Yeah, QFRs a week from today.
Okay, so QFRs as filed will be due a week from today. I hope you will comply. There was a specific request for a response by Chairman Wyden within 2 weeks, and I would hope and expect that would be honored. And with that, the hearing is adjourned. Thank you all very, very much.